Alright guys, so we are back, and in this section I will be talking about the two phases that price typically moves in. No matter what asset and whatever you're trading, price will always have these two phases. And let's write down what these two phases are, as they also similarly relate to market structure and how price moves logically, as well as technically on the chart. So there are two phases. We have the consolidation phase, and we have what I call the expansion phase. We have two phases in the market, okay? And price will move between these two phases. It will shift between these two phases. Now, how can we identify these two phases? Well, first off, let me explain to you guys what consolidation is. Consolidation is what people can call also as bad price action, choppy areas in the market where we don't want to be taking trades. Okay, so here I can immediately identify consolidation. This takes time and practice. As you easily recognize these patterns, you'll be able to recognize many movements in the market. This right here is a clear example of consolidation. So you know what, for the sake of this video, I'm going to color consolidation as red, and we are going to be coloring expansion as blue. So let's look for areas of consolidation. This is consolidation when prices chop around up and down. Now, consolidation happens everywhere on every time frame. So depending on the time frame you're looking and analyzing at, consolidation will occur in different areas. So let's look around and see if we can find more consolidation. Consolidation is actually honestly better, in my opinion, to find on lower time frames, since lower time frames do have more choppy price action. So let's just go to the lower time frames. So again, we will still want to keep in mind price moves in consolidation and expansion phases. Let's go in the lower time frame even more. Let's see if we can find this consolidation. Perfect, right here. This is a perfect example of consolidation, where price is choppy, moving up and down, and doesn't show a clear direction or trend. Consolidation right here. We have some consolidation right here as well. And let's look for other places of consolidation. Look for places where price is chopping up and down in the tight zone. That is how we identify consolidation. Consolidation up here as well. And consolidation right here. And as well, we have consolidation right here. Okay, so now that we have identified areas of consolidation, let me just get rid of this, and we can bring this back over here on the lower time frame. Again, you can identify consolidation on every single time frame, but they occur more likely on the lower time frames due to the insignificant small moves that the lower time frame provides. So, lower time frame, you can see we have consolidation. Consolidation is marked in red. These are areas of consolidation. And the blue areas I'm gonna mark right now is gonna be what we call expansion. All right. This right here is considered expansion. This right here is also considered expansion. And if you guys already noticed the pattern here, just let me know. But this right here, expansion, we have expansion here again. This is some consolidation here. So I'll actually put expansion here. Oh, we have expansion here as well. So now that we've identified these areas, well, what does this tell us? Well, expansion usually occurs after consolidation, but not always. Okay, these two phases work correlating directly together usually. Okay, so expansion or consolidation is basically when prices again chopping up and down, like we mentioned, within a range. This is consolidation. The range size will depend on basically the time frame you're looking at. This is consolidation right here. Okay, expansion is when we break out of consolidation or we have a strong push in a single direction without any hesitation or resistance. So once we break out of this phase, that's when we are in a what I call expansion phase. Okay, so expansion is, think about a balloon. You're expanding. Price is expanding to the upside, or price is expanding to the downside. When we're consolidating, we are going up and down within a tight area and not making any directional change to price. So this again is consolidation. When we break out, consolidation is what we call expansion, or when we have these big rejections where we switch trends immediately, that is also considered expansion. So that is essentially how the market moves. The market has expansion and consolidation within these small internal market shifts in market structure. Again, higher highs, higher lows, that is higher time market structure, along with expansion and consolidation phases. So now that we understand what expansion is and what consolidation is, well, how can we take advantage? So right here, as you guys can see, once we break out consolidation, we always are going to have an expansion move no matter what. No matter what happens, When we have consolidation, we always have expansion. That is just guaranteed. That's how the market moves. So we want to take advantage of consolidation. We don't want to be trading inside consolidation. We don't want to be taking any entries within consolidation usually. Now, there are exceptions depending on how big this consolidation period is. There are definitely ways you could take entries within this consolidation area, but in general, consolidation that's very choppy, not like this, but I'll say more so consolidation like this. This is really good example of consolidation that's horrible. You can't trade in. This is also really bad consolidation. This is consolidation as well. What we like to do is we want to wait for consolidation to break out in a single direction. All right. So essentially, you guys can see we marked out this area consolidation. Let's actually use something else because that's not a good consolidation area. Okay, this is good right here. Once we break out this consolidation area, we then have either push up or down. It's either going to break down or it's going to break up to the upside. Okay, as in this instance, we have broken up. So what we want to do during consolidation is we want to mark the upside and the lower. Basically, we want to mark the ranges of the consolidation, and we wait for this break. Once we break out of this consolidation, also known as a breakout in price, we then enter. So, for example, this would look like this. We would enter off consolidation and target a really nice risk reward ratio. Okay, I'm gonna go later into depth into like where you put your stop loss, take profits, things like that are valid. So don't worry about that too much. But that's essentially how we play these consolidation phases. Now there's certain times where we have fake outs in consolidation where we fake out and then we come back right up. So consolidation is something you want to be careful with. And usually consolidation occurs because of market exhaustion, like we mentioned with retracements. The market is very tired. The market has to collect orders at a certain area before changing directions or picking a direction to go in. Now, when we draw out our bigger, higher time frame validation in the higher time frame zones, you can clearly tell which way consolidation is going to eventually break out of. I haven't gotten to that yet in this section so far, but you guys will definitely later learn in that, and you guys will be able to identify which way consolidation is most likely going to break out in before it even occurs, which is extremely important as well. You need to have a bias in terms of higher time frame to see where consolidation is more likely to break out in. And that way we can either size heavier on that, or we can have a bias of, okay, we're only going to trade if it breaks out this way. That way we don't get things like fake outs like this. We don't get fake outs. So what happens is usually when we're in a consolidating phase, we have a pretty big move, okay? So usually after we consolidate, we have a pretty big move. Now this is not always the case, but as you can see for here, example here, this is pretty big consolidation right here. We have massive moves in both directions after this consolidation. Now, remember what we mentioned about the efficient and inefficient areas of the market? Well, look at what we have here. We combine consolidation expansion phases with inefficiencies in the market. We have combined all the logical pieces of how the market moves. Now we know literally every logical part of how the market moves, and we just have to take our entries based on all this logic combined. Not as easy as it sounds, but there are definitely simple steps that you guys can take to simplify trading as much as possible to the most important things and block out all the noise. Look at what we have here. We have expansion, consolidation, and then we come out with expansion. And guess what? Not only that, we also have an efficient area of the market that I like to call this gap. Look at this. We filled this gap perfectly. We filled this very efficient area of the market perfectly out of this consolidation. So when I see something like this, where I see, okay, we have consolidation above here, guess what? We are most likely, almost certainly going to be pushing down. Why? Because we have this gap to be filled. We have efficient area in the market that price is most likely going to go and attack. The odds of us pushing up from here is extremely low unless we want to be filling this higher time frame gap up here. But again, we want to be selling high. We want to be buying low. That's where we get our best prices, okay? That's what banks and institutions also want to have and achieve. So you want to think on their end. They also want to be selling at high prices and buying at lower prices. So the odds of consolidation when it occurs on the upside is that it is more likely to drop down, while if consolidation is occurring on the bottom, it's more likely to drop up. Now, this is not always the case, and this takes many other confluences you got to combine to understand this, but as the general gist of consolidation and expansion phases. You can identify these across the market on any single time frame. Look at this. We have consolidation right here before we have a big move of expansion. And guess what? Look at this. Look how easy this is to read on the higher time frame too. We have an efficient area. Okay, look, we have an efficient area of the market right here. What do? After we break out consolidation? We fill up that efficient area of the market again. The odds of us, again, breaking down here is very, very unlikely. Unless we reach this area, which we can fill this efficient area of the market. Otherwise, it's very impossible or very unlikely. So there's so many things that you got put together to determine which way consolidation is going. Look at this. Consolidation above here. Where do you think we're most likely to go for price? Well, we are targeting areas of efficient market. This is not as efficient and clean as price action over here. But again, we are at a expensive price, relatively expensive price. We need to be really filling that price point and going back to a fair price point before you push back up again in reverse. Another example here. Here, we actually have the opposite. This is a perfect example of what sometimes happens. This doesn't happen often, but this is a possible outcome. We have consolidation above. But this time, instead of pushing back down, we are pushing back up. And one of the reasons is why is because most of these orders down here have already been touched so many times. We have this area where buyers are putting all their buying orders, as well as big institutions. They've already sick of this area, and we are now trying to get away from this area now. So price gets pushed up. Again, this is when banks and institutions find that, okay, we have a lot of liquidity already over here, and we are able to buy here at a good price. This is now deemed a good price. So now when price comes back, this is now considered a good price rather than the previous relative area, which is here. So something extremely important to understand is combining the logic of the market along with technicals, with their psychology, with the trade management, with everything. Once you combine all these things, you will understand the market so clearly. And once you combine all these things, you will also understand that the market is not rigged. It's not out here to try to get you. Sure, you can say institutions are looking for targeting for liquidity for their orders to get filled. Yes, that is the thing. But the market is not purposely out there trying to get you and try to trick people with things like that. It's just all in your mind and how you are able to understand the charts. If you are fully able to understand liquidity, understand consolidation, expansion, understand market structure, understand all these things and how they all play together a role in where market goes, you will have a true in-depth understanding of the market.